Ladies and gentlemen, welcome back to another episode of Boss Economics World, where we look at the latest brilliant moves our beloved central banks are making to guide our flailing economies into an ever rosier future. While many of you tuning in may already be well acquainted with the magic tricks central bankers pull out of their hats, today we turn our attention to Europe, land of unity, land of crises. The European Central Bank, ECB, is now set to lower interest rates more rapidly than initially predicted, with some entertaining twists and turns along the way. And my oh my, what a treat we're in for. From the services sector sliding into contraction to manufacturers in a state of permanent malaise, it seems none of us will be disappointed by the cascade of coming woes. But before you switch off, thinking, oh no, is this just another gloom and doom story? Wait. I assure you, this isn't merely bad news. It falls under the category of bad policies and worse decision-making that makes for a fantastic economic spectacle. So, what's new this time? According to a Bloomberg survey, the ECB plans to cut interest rates faster and with more gusto than previously expected. There's chatter of a quarter-point reduction coming up, but that's just the start. These reductions will pepper nearly every policy meeting until June 2024, ultimately sinking the deposit rates down to a breathtaking 2%. Yes, ladies and gentlemen, we're racing to a luxurious 2%, and apparently, this is breaking news. Historically, easing monetary policy, slashing interest rates, has been the ECB's go-to tactic for fixing the economy. Back in 2022, there was cautious chatter that rates wouldn't get this low until, maybe a year from now. But our dearly beloved central bank couldn't bear to wait that long. So, here we are. And now, analysts are scrambling to predict exactly how much damage will be reversed, well, sort of. For it merely depends on squeezing that thin juice left in the tank of interest rate reductions. For those of you who are everyday folks, you may be asking yourselves, what's causing such hubris? And the answer is growth, or the lack thereof. The tragicomedy here is that the Eurozone's 20 nations are no longer standing on the stable grounds they once were. Services, which were one of the few life rafts holding steady while manufacturers drowned, are subsiding into that very same contracted reality. And consumer confidence has collapsed like a poorly built economic house of cards. Think about it for a second, businesses are uncertain, consumers are cautious, and governments are waffling. Growth projections and inflation forecasts are being steadily revised downwards by experts, and the ECB is expected to stimulate everyone back to a happy place. Even the ever-optimistic analysts no longer foresee this magical neutrality regarding borrowing costs. Oh no, they now predict that we'll be in truly accommodative, aka free money for some, territory by the end of 2025. Fork out those euros like there's no tomorrow. This entire scenario brings us to a much juicier point of analysis. We need to talk about the bigger structural problems that Europe is facing and why these interest rate cuts are akin to putting a band-aid on a gaping wound. Let's break down what really underpins the Eurozone's malaise. 1. The services sector slip-up. For a while, the services sector was holding up the sky. Meanwhile, manufacturing had long since waved its white flag, especially given the global slowdowns in demand, the ongoing China-related supply chain disruptions, and the general lack of productive investment. Now that services have stumbled into contraction too, we can expect one ugly word to soon rear its head more commonly, recession. According to IHS Markit's Purchasing Managers Index, PMI, readings below 50 indicate contraction. In recent months, the services sector, which had held above water for some time, has dropped below 50. What was once the beacon of hope for the Eurozone now finds itself in uncertain territory. Widespread uncertainty, stagnation, and lack of demand are plaguing both businesses and consumers alike, exacerbating fears of an extended slump. 2. Manufacturing's long-standing problems. Turning to our once proud manufacturing sector, we find no surprises. The decline there is old news, like seeing yesterday's garbage headline, Eurozone factory output contracts, pasted repeatedly, each time with a slightly worse metaphorical smell attached. The situation has been dire for years, and it comes down to global demand. European producers, dependent on open trade and demand from key partners like China, have watched orders slow dramatically. According to Eurostat, in October 2023, manufacturing output in the Eurozone fell by 1.2% on a monthly basis, unexpectedly reversing gains from the summer. Falling demand, ongoing geopolitical tensions, and the tug-of-war over green policies and technical transitions like the electrification of the auto industry are wreaking havoc on production. So, what are the implications when both engines, services and manufacturing, are sputtering? That's what economists would call the precursor to a deeper recession, the same ghost Europe has tried to shake off for over a decade. Now, we are left in a position where more hawkish figures, such as those hailing from France, François Villeroy de Galha, and Portugal, Mario Centeno, are vocally supporting these cuts while tossing around the idea of a more dramatic 50 basis point slash. After all, why wait with a quarter-point dance when you can draw the sword and cut twice as deep? Despite the trumpeting of such high-flying, stimulus ideas, some doves, experts who typically argue for a more relaxed monetary stance, are wary of being too aggressive too quickly. How ironic is it for those fiscal doves to get cold feet about cutting deeper? It underlines just how screwy and shaky the situation really is. Nobody's even sure whether extreme retreats will rescue the day, let alone stimulate recovery. Only JP Morgan boldly predicts 150 basis point reduction in December 2023, while SEB's Jussi Hiljanen optimistically forecasts the big knife will come in March. The debate is whether bigger imminent cuts are really the magic. While degrowth, buzzword alert, is now the term on every analyst's lips, what adds flavor to this toxic brew is confusion over just how bad things will get. Remember that cheerful 0.4% advance in GDP we saw in the third quarter of 2023? Don't let it fool you. Analysts predict weaker and weaker quarters ahead. Sure, consumers were emboldened to start spending, but at what cost? Wages and savings are now stretched thin to cover inflation-ravaged affordability gaps. Of course, we must mention the famed neutral policy, that wonderful area where rates are supposed to neither stimulate nor restrain the economy. Here's where things get absurd. According to Philip Lane, the ECB's chief economist, the neutral rate lies between 1.5% and 2.5%. But wait, 90% of survey respondents, our friendly neighborhood analysts, beg to differ. They almost unanimously place the neutral level lower, say between 2% and 2.5%, while still expecting a stimulatory atmosphere by the end of 2025. More than half even expect inflation to undershoot the ECB's prized 2% target in the medium term. Shrinking inflation forecasts add to the obvious question, which is the ECB even in control anymore? Let's not forget the geopolitical playground Europe finds itself in, rife with external forces that make monetary policy even harder to govern. US policies, trade wars, and tariffs, hello Trump era 2.0, all introduce layers of volatility into Europe that are impossible to ignore. Let's take a moment to consider the impact of Trump's previous economic policies, which may very well resonate again. Trade wars, tariffs targeting European exports, and other protectionist measures have already stifled growth in the Eurozone. And unfathomably, European policymakers still worry more about the repercussions from a renewed Trump protectionist agenda rather than what sloppy internal monetary measures are doing. As Commerzbank's Marco Wagner pointed out, Trump's tariffs will slow growth but are unlikely to much affect inflation. Even under counter-tariffs, European exports stand to lose their competitive edge, leaving a question mark on how the ECB plans to counterbalance these impacts domestically. Here is the grand finale, folks. Amid these projections, cautious cuts, and geopolitics toying with Europe's fragile economy like a cat batting a ball of yarn, there's the question of credibility. Despite Karsten Brzezinski of ING already noting the ECB's restrictive policies being a risk, and even Philip Lane himself alluding to pushing rates toward neutral, there's still minimal consensus on how fast to move or how deep cuts should go. But what's funnier is that while 53% believe policymakers will shift their language, the overwhelming majority still believes the ECB will hesitate to provide clear guidance on where rates are headed. Let that sink in. We're talking about the institution responsible for steering the macroeconomic ship of 20 nations, and while they may alter their phrasing, because that helps, right, we probably won't get anything resembling a definitive strategy. Keep rates restrictive. Move to neutral. Reduce inflation risks. It's like watching a three-ring circus where nobody knows which performance is next. The ECB's credibility, like its rate projections, continues to wobble. Lagarde's leadership has faced challenge after challenge, from inflation surges to recession risks, and now, policymakers seem more concerned with rhetoric than action. Many analysts, such as Dennis Shin of Scope Ratings, note the dilemma that haunts the ECB's approach. They must offer some monetary support to mitigate recession risks but can't be seen as too lenient, lest they lose grip on future inflation creeps. In summary, the ECB is dancing on a tightrope, trying to balance short dash, medium dash, and long-term objectives amid growing skepticism. Before we get too mired in the dizzying specifics of interest rate cuts and ECB internal battles, let's zoom out. The Eurozone economy isn't suffering from a temporary fever brought on by inflation or a regulatory mishap. No, the region is grappling with deep structural problems that no quick monetary remedy can fix. Herein lies the crux of the issue. No matter how many times Lagarde pulls the lever for lower rates, the Eurozone is shackled by greater forces that aren't so easily manipulated. Let's dig deeper into four core issues. 1. Demographic time bomb. Europe's demographic crisis is slowly but surely strangling its potential for growth. We're looking at an aging population across the Eurozone, with birth rates that have been slipping for years. Take Germany, the economic powerhouse of Europe. Its fertility rate stands at around 1.5 children per woman, well below the replacement level. Meanwhile, more and more people are retiring, and the younger generation, the economic lifeblood of future growth and innovation, is shrinking. The European Commission's projections show that by 2050, those aged 65 and over will make up nearly 30% of the total EU population, compared with 20% in 2023. This demographic decline translates directly into lower labor force participation, lower productivity, and a heavier burden on social welfare systems. In simpler terms, the Eurozone risks becoming a stagnant economy with dwindling innovation and spending capacity because there simply won't be enough people driving either. 2. Zombie companies and lack of innovation. The low interest rate environment that the ECB has fostered for so long has inadvertently given birth to a breed of so-called zombie companies that stagger along despite being inefficient and unproductive. When borrowing costs are low for nearly a decade, poorly performing firms, which, in a more competitive environment, might have collapsed, can continue to limp along, inflating the failure-averse, low-growth economy we now face. According to the Bank for International Settlements, BIS, as much as 15% of all publicly listed companies in Europe are classified as zombies, unable to cover their interest expenses from operating profits. By propping up the weaklings, the ECB's long periods of low rates have starved innovation, which would typically thrive in environments where only the strongest and most adaptive firms survive. The Eurozone, once a hub of cutting-edge industry and innovation, risks becoming a landscape of outdated business models propped up by endless debt, unable to compete against the nimble economies of the US and China. 3. Productivity stagnation. Productivity growth in the Eurozone has stagnated for years. From 2010 to 2020, productivity growth hardly exceeded 0.9% annually. Compare that with the roaring post-war decades where growth averaged nearly 5%, and you'll see how much Europe has lost the plot on this front. As productivity stagnates, so does the capacity for real wage growth, dragging consumer demand and economic dynamism in its wake. Despite all the millions poured into technological grants, digital transformation projects, and educational reforms, the problem persists. Why? Because labor market flexibility and bureaucracy remain huge barriers. Layers of regulations, many intended to protect workers, act as a double-edged sword, reducing the economy's ability to adapt to new technologies or redeploy resources efficiently. 4. Geopolitical vulnerabilities, the impact of Trump, China, and the Global South. As we touched on briefly earlier, the Eurozone exists in a vulnerable position, not only because of its own internal dysfunction but because it's frequently caught in the crossfire of global geopolitical skirmishes. Before anyone jumps to the conclusion that Europe's woes are purely the product of sluggish economic design, let's take a look at how the external factors play buffoonishly into the picture like bad actors in a bad play. One name and era that continues to loom large is Donald Trump. During his presidency, tariffs on European products, particularly on German autos and French luxury goods, caused significant damage to exports, threatening the competitive edge of Eurozone manufacturers. And though some of the bickering quieted during the Biden administration, hints of Trump's return to power in 2024 remind EU policymakers that protectionist measures may soon be unleashed once again. When Europe relies on US and Chinese demand, the disruptive presence of trade wars and tariffs can only exacerbate the already fragile state of the economy. Plus, the Eurozone's reliance on Chinese demand for its exports has become another peril in a global market quickly souring on China, given political tensions, human rights concerns, and supply chain fragilities exposed during the pandemic. And let's not even mention the various African, Middle Eastern, and Global South economic realities that continue to destabilize European supply chains and create risks in resource supply lines, from metals needed in batteries to natural gas dependency on Russia. So, we come back full circle to where we began. Let's be honest, has the ECB truly grasped the magnitude of these issues? Does chopping 25 basis points off the deposit rate in a quarterly, steady stream of cuts fantasy scenario really compensate for the deeper pain gripping the Eurozone economy? To answer bluntly, no. The ECB's broader challenge isn't just addressing today's inflation hiccups or this year's limp GDP growth rates. It's about dragging the Eurozone toward a cohesive long-term strategy that lifts it out of structural recession mode while simultaneously plugging holes from trade wars, demographic decline, and obsolete zombie corporations. And let me tell you, folks, cutting interest rates carries about as much long-term strategic vision as handing out aspirin at a surgery theater. Sure, it might alleviate some immediate symptoms. But will interest rate cuts keep Europe's economy competitive in a world increasingly dominated by technological innovation from the US and China? Will these minor tweaks stave off demographic woes that threaten to make the whole continent one big retirement home? Absolutely not. That's right, you heard it, stagflation. Unless something magical happens, Europe isn't limping into just a temporarily bad year, it's potentially crawling into an extended period of stagflation, where stagnant growth meets frothy price increases in a bitter marriage. Remember, Germany recently teetered on the edge of recession, and with other Eurozone major players close behind, the ECB is using these rate cuts as a last-ditch effort to avoid plunging headfirst into this economic quagmire. Yet as inflation ghosts loom large, the double bind remains: cut too much too fast, and inflation risks reblooming. Too little, too slowly, and we all dive into recession anyway. Ultimately, folks, the famed monetary arsenal of the ECB is looking rather empty these days. The quicker-than-expected rate cuts are one sorry weapon of choice in the macroeconomic theater of the absurd we now find ourselves in. The policymakers may appease the markets temporarily, but the bigger unanswered questions persist. What is the real long-term strategy to tackle the age-old scourges of Europe's rigid governance, bureaucracy, lackluster productivity, and geopolitical overexposure? Until we have answers to those questions, we'll simply have to watch central banks, once again, ask you to hold your breath for each quarter-point melee. Hey, there's always next quarter. Right?